Hello and a very warm welcome to this webinar on the UK's new asset holding company regime. My name is Russell Warren and I'm one of the tax partners at Travers Smith, and I'm delighted that you could all join us today. As you'll see, I'm joined by a number of my colleagues. So what I'd like to do is to start by giving an outline of what we're all going to cover today. So in a moment, I'll begin by giving a quick general introduction to the regime, and I'll outline the key tax measures and the qualification criteria. I'm then going to hand over to Elena to discuss what is going to be a key area of interest, which is the ownership condition and how it applies to funds and partnerships in more detail. Elena is also going to talk about credit a little bit later. Simon and Sophie will then talk about using AHCs in the context of PE acquisition structures. And then we'll hear from John on pan-European real estate structuring. So quite a lot to get through in the next hour as we cover PE, credit and real estate strategies. But we do want to hear from you. So if you have questions, please do feel free to ask them in the chat box. So to start with, what is the asset holding company regime, or why is it being introduced now? So in short, this is all about making the UK more attractive to asset managers and the funds industry. There is a wider review that's ongoing on making the UK more attractive place for funds and to be more competitive and to encourage funds to co-locate here in the UK with fund managers. And the introduction of the asset holding company regime is a result of one part of that review. Now this, of course, is a tax measure designed to provide a tax-efficient asset holding company for funds that compete with regimes in rival European fund centres, of course, thinking there about Luxembourg and Ireland. The regime comes into force this April, and we have fairly advanced drafts of legislation, so we have a pretty good idea of what the rules are going to say. And I should say that we have had the benefit of meeting with the Revenue and Treasury during the development of the regime, either as Travers Smith partners or as members of the various industry bodies that we sit on. So what we're going to discuss today reflects not only the legislation, but also those conversations. So what does the regime offer for those holding companies that qualify? Well, there are some pretty generous tax reliefs available. They're up there on the screen. I'm going to talk about a couple of them. The first is that there is a complete exemption for gains on the sale of shares, and this effectively replaces the UK's substantial shareholding exemption, which is seen as quite a difficult relief. The AHC exemption is far from it. It's very straightforward. The only complication, such as it is that it won't exempt gains arising on the sale of UK property-rich companies. And that's to be expected. This regime is not designed for UK real estate. This is something John will elaborate on in a little bit. There is also an exemption from the requirement to withhold on interest payments. And this is helpful. It removes the admin burden and costs of having to list your loan notes, but it's probably no more than that. But coupled with the fact that the UK doesn't have a withholding tax on dividend payments, put those two things together and you have quite a efficient structure with no withholding tax exposure. The AHC, though, isn't entirely exempt from tax and will be subject to tax on its profits. Simon will discuss how switching off of the corporation tax distribution rules impacts this, but the expectation is that AHC should have a very low corporation tax profile, as it will only need to recognise profits proportionate to the value of its activities. And as a holding company, those should be pretty minimal, but they will, of course, need to be transfer priced. It's also going to be possible to extract value out of an asset holding company in capital form by way of a share buyback. And this is quite a significant change because ordinarily, if you're buying back shares of a UK company, that will give rise to income treatment in the main part. But here we can do a share buyback and it will deliver a capital receipt. Now, the UK corporate law isn't being changed, so you still have to have distributable reserves to effect the buyback, but if you have them, you'll get a capital return. And Simon will talk a little bit more about how you might think about structuring with AHCs to reflect this interaction between the beneficial tax treatment but the slightly inflexible UK corporate law. And finally, the regime also amends the remittance basis of taxation for fund managers who are UK tax resident non-domicile. Now, ordinarily, a return received from a UK company would be treated as arising in the UK and therefore taxable. But the AHC rules amend that to split returns arising from underlying UK assets of the asset holding company and non-UK assets of the asset holding company. And it's only those returns from the underlying UK assets which are taxed on an arising basis. Returns that arise from underlying assets outside of the UK will be taxed on a remittance basis. And I think this removes what would otherwise have been quite a big disincentive to establish AHCs. Now, there are other changes to the UK tax rules for AHCs. We'll mention some of them, but you can see just with the list that I've covered, the regime provides a very attractive tax regime for holding companies if you could get into the rules. So, how do you get into the rules? Well, I've put the key tests up there on the screen, and I want to draw out two of them, which we'll talk about in more detail as we talk about the particular asset classes we're going to cover. The first is the ownership condition, and that requires the AHC to be owned as to at least 70% by what are called Category A investors. And this includes other qualifying asset holding companies. We'll talk about asset holding company stacks. It also covers qualifying funds, and I think this is going to probably be the most important type of Category A investor. Elena will look at this next, as well as a number of other institutional style investors. And the way that you work out the holding percentage of a particular investor in an AHC, or referred to as relevant interest, is a little unclear in the legislation. It looks to both economic participation, which adopts the form of the equity holder test taken from the group relief rules, as well as votes. And Elena will talk a little bit more about this, but in practice, if an asset holding company's shareholders' economic participation in the AHC is proportionate to the interest that they hold, then running the ownership test will be relatively straightforward. As Simon and Sophie will touch on, we actually expect to see tracker shares used in AHC structures. This will slightly complicate the ownership calculation, and in that case, the ownership test will need to be met for each class of tracker share. More on all of this shortly. I also want to just highlight the investment activity condition, and this provides that the AHC cannot trade or carry on any other activity to any substantial extent. It has to carry on investment activity. And we understand that the revenue take this to mean that if an investor would be uninterested in the activity of the AHC when thinking about whether or not to invest, then that activity won't be substantial for the purposes of this test. Elena will talk about this in the context of credit funds in particular. The other conditions, I think, in practice are unlikely to give rise to too much uncertainty or difficulty, but we'll discuss some of those as we go through. So let's now focus on the ownership test, and I will hand over to Elena.
Thanks, Russell. So out of the qualifying conditions that Russell mentioned, the ownership condition is really the only condition that's probably technically complex, and in most cases it's likely to be obvious whether or not it's met, but it does have some nuances that are worth exploring, because there will be times when it is a close call in terms of the QAHC having sufficient good category ownership. So before looking at the example on this slide, there are just three key points that I wanted to make. The first point is that although it's often framed as requiring 70% ownership by Category A investors, actually the ownership condition is whether or not non-Category A investors have more than 30% ownership of the QAHC. And those are not the same things, because due to the way that relevant interests in QAHCs are calculated, it is possible for both Category A investors to have 70% ownership and for non-Category A investors to have more than 30%. The second point to make is that relevant interests that count towards the 70-30 calculation are direct economic and voting entitlements in the QAHC, but there are two exceptions to this. So the first exception applies where there is an anti-fragmentation rule, and the second exception applies where there is a stack of QAHCs. and I'll come on to explore those two exceptions in a bit more detail. The final point to note is in relation to carried interest arrangements in the QAHC itself. So what you do is you take the maximum entitlement of carry that could arise over the life of the arrangement, and whilst that is unhelpful in the sense that it increases the interest of management in the QAHC when the carry hasn't yet kicked in, it is helpful in that it doesn't prevent a company being a QAHC during any carried interest catch-up period when management are entitled to 100% of the profits. So with those points in mind, if I now just turn to that diagram on the slide and consider first who are category A investors. So as Russell mentioned, the legislation lists the various categories, and they are typically the types of tax privileged institutional investors that you would typically expect. So most pension funds, sovereign wealth funds, charities, they will all be category A. They also include qualifying funds and QAHCs themselves, thereby allowing QAHCs to be stacked, which Simon and Sophie will come on to. So if we look at this example, you can see that we have a range of investors. So if we start first with the qualifying fund on the left, I'll come on to explain what I mean by a qualifying fund in the next slide. But the point to note in this example is that if you have a qualifying fund, it effectively acts as a blocker, meaning that it's generally not necessary to look behind the fund to determine the investors if the investors in the fund are category A. So here you'll see that the investors in this fund are all individuals, and so non-category A investors. However, because the fund is a qualifying fund, this doesn't matter. Now, I say it generally isn't necessary to look behind a qualifying fund to determine if investors are category A, because there are some nuances to this. And one of these nuances is where the anti-fragmentation rule applies. So broadly, the anti-fragmentation rule applies if a non-category A investor holds an interest in the QAHC both directly or through a connected non-QAHC company, and partly through another person that is not a QAHC. So in our example here, you'll see we have individual members of the management team who hold a direct interest in the QAHC and also an indirect interest in the QAHC via the qualifying fund. So in this example, you would have to aggregate management's direct and indirect holdings when assessing their total holding for the purpose of the 30% rule. The next three examples are relatively straightforward. So the UK REIT, it's a qualifying fund, the sovereign wealth fund and the pension fund should also fall within the list of qualifying investors, and so they are also both category A investors. If we next turn to the insurer, so what the rules say is that a person acting in the course of an authorised long-term insurance business is a category A investor. However, in this example, the insurer is investing through a 100% owned UK company. Now, normal UK companies are not category A investors, but intermediate companies are. Now, an intermediate company is broadly a company that meets the activity condition and is at least 99% owned by one or more category A investors. So in this example, assuming that the UK company here is carrying on an investment business, it should qualify as an intermediate company. If we then turn to the last two investors, well, assuming that the UK corporate is not a fund and it's not an intermediate company, it will not qualify as a category A investor, and similarly the family office doesn't fall into the list of qualifying investors, and so it is also a non-category A investor. So that was a very brief run through category A investors. Now, as Russell mentioned at the beginning, the most important category will often be qualifying funds. So if we now turn to the next slide to look at this category in a bit more detail. Now, before looking at each of the examples here, the key point is that to be a qualifying fund for purposes of the ownership condition, an entity has to fall into one of three categories. So it can be a collective investment scheme which meets the requirement relating to being widely marketed. That's commonly known as the genuine diversity of ownership condition, or GDO. It has to be a CIS or an AIF, which is not close, i.e. it can't be controlled by 5 or fewer persons, or alternatively, it has to be a CIS or an AIF, which is 70% controlled by category A investors. Now, the key concept used in each of these 3 tests, CIS, AIF, GDO, non-closeness and 70% control, those are all quite complicated concepts, and we don't have time to go through them now. However, we can look at some of the examples on this slide in order to bring out some of the key points. Before I do that, one point to note, as I'm sure many of you will be aware, is that a closed-ended corporate fund cannot be a CIS, and so cannot rely on the GDO condition. So if, for example, you had a Lux SCA, that wouldn't be able to rely on the GDO, and you'd have to rely on either non-closeness or 70% control by category A. So if we go through each of the investors on this slide, if we start on the right, we can start off with a UK investment trust. It will not be a CIS because it's a closed-ended corporate, but let's assume here that it is an AIF, and due to its wide shareholder base, it is not close, and so it will be a qualifying fund. If we then move along to the listed TechCo, even though it is also a listed company with a wide investor base, it is not an AIF and it's not a CIS, and so it's not a qualifying fund. If we then move on to the LTAF, this is in the form of an open-ended investment company and so would be a CIS. However, it only has 5 pension funds, and so it might not meet the genuine diversity of ownership condition. However, the 100% ownership by pension funds should allow the LTAF to be a qualifying fund as a result of meeting the 70% control test. So far, so good. That then leaves us with 2 limited partnerships to assess. And the reason I've included these is because it illustrates an important pitfall with the rules, which is that you have to assess the qualifying test on an entity-by-entity basis rather than assessing entities in the same fund arrangement as a single unit. So in the example I've got here, we have a successful, widely held private equity fund and a parallel vehicle that has a single non-category investor. Now, they are both part of the same overall fund arrangement, but the parallel vehicle will not be a qualifying fund, and so its 5% ownership will count towards the bad holding in the QAHC. However, if that same non-category investor had invested in the main fund through a feeder instead of the parallel, so that in our example the main fund held 30% rather than 25%, then the entire holding of the main fund would have been good. So what that means is that if it's commercially viable, adopting a feeder structure rather than a parallel structure would be better for the purposes of the ownership condition. Now, if we look at the main fund, we would expect one way or another for that entity to be a qualifying fund. I say one way or another because it's not entirely clear how you apply the GDO to a close-ended fund, especially one run by successful managers which may do little or no marketing. However, even if it doesn't pass the GDO, we would expect it to be non-close on the maths. And that's because, although you assume that management have their full carry entitlement of 20%, the other 4 top shareholders are not enough to give the top 5 investors control. Now, the final point on this slide, if you look at the bottom, is that even though a QAHC is itself a qualifying investor, it doesn't always act as a blocker when considering whether a QAHC in which it has an interest meets the ownership condition. So in the example I've got here, we have a master holdco, which is a QAHC, as it has 75% category A investment via successful PE fund for the LTAF and the investment trust. However, Topco is not a QAHC, and that's because you need to aggregate management's direct 10% holding in Topco with the 22.5 indirect non-category investor in it held through master holdco by the listed tech company and the parallel fund. So that's a very quick run through the ownership condition. I know that those rules come across as incredibly complex, but I think the main message is that if you have a qualifying fund in the structure, we would hope that it's relatively straightforward to satisfy the ownership condition. I'll now pass over to Simon and Sophie, who are going to run through how QAHCs could be used in private equity structures.
Thank you, Elena. So we're now going to take a look at some options for structuring. First, with Sophie and I looking at this in the context of private equity transactions. Then Elena will have a look at credit, and John will finish off with some thoughts on international real estate. This is going to be a bit of a whistle-stop tour, as we wanted to focus in detail on the eligibility criteria and in particular the ownership condition that Elena has been discussing. But we'll now run through some private equity structures just to bring out in practical examples some of the points Russell and Elena have discussed, starting with a couple of points that Sophie will talk us through.
Thanks, Simon. So here you can see the PE fund has established a master holdco QAHC through which it makes its investments. And the master holdco issues tracker shares and tracker profit participating loans to the PE fund. Now, these tracking securities essentially back-to-back the securities issued by the underlying investments. And Simon will come on to talk a bit about the tax consequences for the QAHC of that capital structure. But first, considering the ownership condition implications of this structure. As Elena discussed, if the PE fund is a qualifying fund because it meets at least one of the GDO test, non-closed test or 70% test, which is what we would generally expect, then it is only necessary to look at the PE fund in performing the calculation of the ownership condition for the QAHC because it acts as a form of blocker. In other words, we don't need to trace through the PE fund to the underlying investors in order to consider whether there are ultimately 30% bad non-category A investors, assuming that the anti-fragmentation rule is not in play here. Importantly, the ownership condition is an ongoing requirement, and the QAHC must take reasonable steps to monitor whether the ownership condition is met throughout its life. Now, the level of ongoing monitoring and scrutiny required will depend on what the qualifying fund looks like, by which I mean how comfortably it meets the requirements of the applicable qualifying fund condition. For example, if the PE fund is 71% held by category A investors and is relying on the 70% test, clearly there will need to be much more ongoing vigilance and scrutiny than if it were to be relying on the non-closed test and is held by a large number of investors, each with very small holdings. The requirement for ongoing monitoring will be built into the provisions of the articles of the QAHC in relation to its shareholders, and possibly also into the fund documentation if it's intended at the outset that the structure will use a master holdco QAHC. Now, if the private equity fund does not meet any of the conditions to be a qualifying fund, then it will be necessary to trace through the private equity fund to assess whether there are 30% or more non-category A investors. Assuming there is carried interest within the structure, given that carried interest is held by non-category A investors and is assumed to be at its highest proportionate return over the life of the fund, so usually 20%, this means in practice that there's then only 10% remaining of the fund's interests available to be held by non-category A investors. And in those circumstances, HMRC would expect ongoing monitoring to be more rigorous. Now, turning to the tracking securities issued by the Master Holdco QAHC. As Russell mentioned, the ownership test applies not only to the QAHC as a whole, but to each class of tracking security. And it's important to remember that if one class of tracker security is held 30% or more by non-category investors, then the entire Master Holdco will breach the QAHC regime. Now, the issue of tracking security should not cause complications for the ownership condition calculation, where all tracking securities are held directly by the qualifying fund PE fund, or where all tracking securities are held proportionately by all investors. However, where that's not the case, the initial ownership condition calculation and the ongoing monitoring will be more challenging. In practice, this would occur where non-category investors participate directly in the QAHC, or where a fund that holds the QAHC is not a qualifying fund and contains streaming provisions, allowing the ultimate investors to participate in certain underlying tracking securities more than others. The requirement for ongoing monitoring means that care should also especially be taken, not just at the fund level, but upon any co-investments or syndication at the Master Holdco QAHC level. The articles of Master Holdco should contain provisions to prompt a consideration of the ownership condition upon any potential co-investment or syndication. Again, where tracking securities or other enhanced classes of securities are being issued on a co-investment in Master Holdco, care needs to be taken not to breach the ownership condition of the entire QAHC by virtue of the co-investor holder of that particular class of security. In the context of co-investment, it should also be noted that on a transfer of shares or profit participating loans in Master Holdco to a third party, stamp duty will in principle be payable because PPLs will not benefit from the loan capital exemption as vanilla loan notes do. For those reasons, it may be better to bring in non-category A co-investors below the level of Master Holdco, unless the topco is also a QAHC. Ultimately, the message here is to take care not to de-QAHC the QAHC, which could easily be done if thought is not given to the structure of co-investment certification.
Bless you, John. That brings us to the structure of the AHC itself. In this example, we've assumed that the Master Holdco invests in the various target groups by way of strip made up of ordinary shares and loan notes. It's important that the QAHC is symmetrical. So if it subscribes for debt in Topco, it needs to be funded with debt. This is because the QAHC is not exempt from tax on income, only on gains. So it needs a deduction to match the taxable receipt on the Topco loan notes, which it gets from the profit participating loan. While the return on debt with profit participating features is generally treated as a distribution and so not deductible for tax purposes in the UK, there is a special rule for a PPL issued by a qualifying AHC, which turns off that provision in the distribution code so that interest on a PPL can be tax deductible. Do we even need a PPL, or could we just mirror the instruments in Topco and have an ordinary loan note issued by the Master Holdco up to the fund? Yes, that's possible, but as we'll discuss in the context of the acquisition stack, that may mean a greater taxable margin needs to be recognised in the Master Holdco. If, on the other hand, the Topco was instead funded with equity, including preference shares, then it would be possible to fund the QAHC with similar instruments, as it would not need the deduction that the PPL gives. Turning then to the mechanism for returning proceeds to investors, well, that will depend on the funding structure. Income received by the Master Holdco would be paid out under the PPL, and that payment on the PPL will be taxed as income in the hands of UK investors in the usual way. The tracker shares would, as the name suggests, track the value of the relevant underlying ordinary shares. The expectation is that that value would then be paid out by repurchasing the tracker shares after exit from the investment, and then under one of the special rules that Russell mentioned, any premium on the repurchase of the shares would be treated as capital, not income, for a UK shareholder. In addition, the transactions in securities rules are switched off so that the return should not be recharacterised as income under those rules. Using a share buyback of the tracker shares, though, raises a company law question. If the Master Holdco is incorporated in the UK, then there are reasonably restrictive company law rules that require a repurchase of shares to be out of distributable reserves or a fresh issue of shares. It may be that the sale by the Master Holdco of the Topco shares gave rise to distributable reserves in the Master Holdco, or that these could be created in the Master Holdco by a reduction of capital, which is a fairly straightforward process these days for private companies. The other option would be to have a Master Holdco that is UK tax resident, because that's a requirement of the rules, but incorporated in a jurisdiction with more flexible company laws, such as the Channel Islands. This would need to be considered carefully, as a number of jurisdictions, including several in the EU, have introduced anti-abuse rules that look not only at tax residence, but also at place of incorporation. An alternative that we're considering is using a double QAHC structure, the top one being non-UK incorporated, and the lower one, possibly a transaction-specific feeder, would be UK incorporated. This may assist with those anti-abuse rules at the lower level, but still allow the upper Master Holdco to rely on the more flexible company law rules to deliver a repurchase of shares. So we're now going to take a look at the possible use of qualifying AHCs in acquisition stacks. And for this, we're not going to start with the QAHC itself, but below it. One point here is that the rules include a ring fence around the QAHC entities, which prevents, among other things, tax reliefs arising in a QAHC being surrendered to a non-QAHC. Why is this relevant here? Well, senior debt will typically be borrowed by one or more local bidcos as needed for the debt pushdown into different jurisdictions, and tax relief will be expected to arise on that senior debt. That tax relief is then made available to the operating company below by group relief, fiscal unities, tax consolidations, or profit and loss transfer arrangements, depending on the jurisdiction. Therefore, each bidco will match the location of the operating group, and where the tax capacity is not in the UK, neither will the bidco be in the UK. But even if the operating group is in the UK, and therefore bidco is a UK tax resident company, the bidco needs to be outside the QAHC ring fence to allow it to surrender tax relief down into the operating group. So either way, bidco should not be a QAHC. Note that the usual tax rules apply below the QAHC ring fence, and so bidco will be funded with ordinary debt and not a PPL. Moving back to the top of the group of the acquisition stack now, and let's look at the ownership condition in the context of topco. As we've seen, this requires that topco has 70% good investors, or more accurately, can't have more than 30% bad investors. And we're assuming, just for this example, that the fund is 100% good. If so, the key will be that management does not exceed 30%. How do we assess that? As there'll be a mix of instruments at topco. Well, this will need to be looked at on a case-by-case basis, in particular because the rules bring in various parts of the group relief tests. For example, the special rules for shares that have limited rights and for option arrangements. One way to get an initial read on how these rules would apply would be first to apply the ownership condition to all the equity, including the prefs and the PPL, and then secondly, by reference to just ordinary shares of topco, and factoring into that gross shares, those with ratchets, doing that on a fully diluted basis and looking at the highest proportionate return those ordinary shares get. You'll need to fall below 30% on each of these bases. One further point to note is that the structure will need to manage and factor in bolt-ons if these are to have an equity component, and future equity issues to ensure that the QAHC doesn't cease to qualify in the future. Turning next to the funding for topco, as we discussed in the context of a master holdco, there needs to be symmetry between the funding at the bottom into bidco and the funding into the top of the QAHC stack. So in our example, there's a downstream loan to bidco, and so topco should be funded with debt, either a PPL or a loan note. Two ways in which the use of QAHC simplify the structure. First, there is no withholding tax on debt owed by a QAHC, so there's no need to list any of the shareholder debt. And second, the stapling distribution rules are turned off, and so there's no need for a separate midco sitting between topco and cleanco. Instead, the shareholder debt can be issued directly by topco. As we discussed in the context of master holdcos, the PPL will be used to reduce taxable income in the QAHC. While in principle the funding of topco could be through a standard loan note, not on profit participating terms, we understand that HMRC think that this could have consequences for the margin that topco recognises under the transfer pricing rules. Their thinking here is that the margin in topco depends on the risks borne by and functions carried out by the QAHC. If the QAHC is not taking risk on the performance of the underlying business because the return it has to pay on its debt is profits dependent, then that may mean that a reduced margin needs to be recognised by the QAHC. We think this debate will be something where clear market practice develops over time, and that ultimately we expect HMRC to want to encourage take-up of the regime and so to be practical in its application. Next, looking at the return of value from TopCo, and the same principles will apply as on the master holdco. As discussed earlier, might this mean that TopCo should be non-UK incorporated and UK tax resident instead, with CleanCo as a UK incorporated and tax resident entity, in order to allow TopCo to benefit from the more flexible company law regime that it is incorporated into? But this may not be a key concern if it is not expected that cash will flow up the group during the life of the investment, and the anticipated exit will be by disposal at the top by sale of the TopCo shares. In that case, this may only be an issue for refis, partials or breakup bids. One point that will definitely require further discussion is to explain to management what the tax treatment would be for them, both of share buybacks and of the PPL. On the share buybacks, the special rules that we mentioned earlier, which switch off both the distribution treatment on a return of capital and the transactions in securities rules, unfortunately do not apply to management. So management may be materially worse off than would be the case on a direct sale by them of their shares in TopCo. On the PPL, management would already be expecting income on their return, but the drafting could be important for other reasons. For example, if this is a deeply discounted security or DDS, then CGT rollover would not be possible and a capital loss would not be available if the investment performs poorly. One point to note on the use of a PPL is that it would not fall within the usual stamp duty exemption for loan capital, as Sophie mentioned. That means that a transfer of an interest in the PPL is in principle subject to stamp duty, which could be relevant for post-transaction co-investors or syndication. Finally, you'll note that we've included CleanCo in the structure. That is not tax-driven, but is likely to be required by the senior lenders in order for CleanCo to give effective security over the shares in BidCo. As it's required anyway, the question is whether it should be a QAHC. Since there are reporting requirements at the level of TopCo, and given the QAHC status of CleanCo will stand or fall by the status of TopCo, there seems little downside to CleanCo also being a QAHC, and a couple of upsides. Firstly, that CleanCo could be UK incorporated and TopCo could be incorporated offshore. And second, that a partial exit could be achieved by moving assets on a tax neutral basis into a new sub below CleanCo, with CleanCo then selling the sub within the generous CGT exemption for QAHCs. Now I'm going to hand over to Sophie to note a couple of points at the level of the investor.
Thanks, Simon. So in terms of the ownership condition at the fund level, there are just a couple of points to note at this point. I'd add firstly that this structure works best and is most viable if the PE fund is a qualifying fund. If the PE fund is not a qualifying fund, then this structure is likely to be a lot more challenging because of the carried interest held through the PE fund, together with participation of management directly in TopCo. In addition, if the PE fund uses parallel structures that invest directly into TopCo, then as Elena mentioned, the rules assess each of those funds individually, i.e. they are not aggregated within the main fund for the purposes of the qualifying funds tests. It may be that parallel funds are themselves structured as QAHCs as a potential solution to that. So imagine in this example a parallel QAHC participating in the TopCo QAHC alongside the PE fund. As we know, a QAHC is a category A investor in itself, and so the QAHC parallel fund would be a good investor alongside the PE fund. However, whilst that might be the analysis on day one, TopCo will want to be sure that the parallel fund QAHC is not at risk of breaching the QAHC rules and ceasing to be a QAHC within the life of the investment, and therefore becoming a non-category A investor. In that scenario, where the ownership condition calculation is likely to be a bit tighter and potentially close to the threshold of 30% bad investors, maintaining category A investors is going to be critical. If the parallel fund QAHC ceased to be a QAHC, it could cause both TopCo and MidCo QAHCs to cease to be QAHCs as well. We would expect TopCo to ask for assurances from the PE fund and its parallel structures that they will not change their ownership structures such that TopCo may no longer qualify as a QAHC during the life of the investment, and for such assurances to be embedded into a shareholders agreement. It may also be prudent to agree that in the event that the parallel fund quack looks at risk of breach of the regime, that a restructuring takes place such that the parallel fund quack then starts to participate through the qualifying PE fund as a feeder, as Elena mentioned, assuming, of course, that such restructuring does not affect the PE fund status as a qualifying fund.
Thank you, Sophie. So finally, on the PE side, we're going to look at the position for an investment-specific feeder code for the fund. Largely, the tax points that are most of interest here are the ones that we've looked at already, including the need for symmetry in funding in and out of the feeder co, the significance of the location of incorporation as well as residence, and the tax treatment of the quack and its investors. One further point of interest is the potential for third-party borrowing at the feeder co level. Where this is a possible route, it will need some thought up front. Even where the investor strip does not include loan notes, it may be preferable for the initial funding of the feeder co to include shareholder debt, possibly non-interest bearing, which could be repaid using the debt subsequently borrowed from the third parties. Where the investor strip includes debt lent down into the investee company, feeder co will have been debt funded anyway to ensure symmetry, and then there'll be a balance to be struck between, on the one hand, the ease of extraction through feeder co repaying part of the PPL, and on the other, the need for feeder co to retain sufficient tax deductible debt to shelter any income on the investor strip. Similar points and a similar need for modelling in the feeder co would arise on the flow of funds up to feeder co following a partial exit or a refi in the investee group. Now, to wrap up this part, I'm handing over to Sophie on a couple of points for the fund.
So I'd just reiterate 2 points on the ownership condition for feeder co, thinking about its ownership by the PE fund. Firstly, that again, the ownership condition is likely to be straightforward where the feeder co is 100% held by a PE fund that is a qualifying fund. The same points apply that care should be taken on any syndication or co-investments at the feeder co level. And secondly, a reminder again that if the PE fund is not a qualifying fund or is a qualifying fund but has marginally met the necessary conditions, that much more rigorous ongoing monitoring of the ownership condition will be required.
Now we're going to hand over to Elena to talk about credit.
Thank you. Yes, so turning now to credit funds. So typically credit funds are structured with tax transparent limited partnerships or tax exempt corporates, which are formed to pool investment from investors, with the assets almost uniformly held through an underlying company. And it's vital to the structuring that this underlying company doesn't impose a layer of tax other than that which the ultimate investor would have paid had they invested in the invested directly in the underlying asset. So before looking at what a credit fund might look like if the underlying company were a quack rather than an Irish or a Lux entity, there is just an important point to make in relation to the activity condition, which could be more of an issue for credit funds than, say, private equity or real estate funds. So as Russell mentioned at the beginning, to be a quack, the activity condition has to be satisfied, i.e. the main activity of the quack is carrying on an investment business and any other activity should be ancillary and not to be carried out to a substantial extent. And that means that you really need to take some care where any activities of the quack could be viewed as trading. Now, unfortunately, the legislation doesn't contain any provision on the distinction between trading and investing. And that means when assessing whether the condition is met, you have to turn to what are known as the badges of trade. And anyone who has had the unfortunate position of having to look at those badges of trade in any detail will know that they can be difficult to apply, particularly sometimes in a credit fund context. And of particular concern to credit funds and a bit of a grey area is loan origination activity. Now, we were hoping that the revenue would say that loan origination activity is fine. They haven't yet said that, but we, along with industry bodies, are hoping that there will be some guidance provided in the HMRC guidance, including possibly an example of when loan origination would be viewed as investing rather than trading. I'm hoping that we'll get to the right answer on that, but as yet those conversations with HMRC are ongoing, so we will keep you updated on that. So if we now turn to the diagram, here we've got a fund in the form of a limited partnership with a wholly owned sub in the form of a QAHC. The fund draws down from investors and provides funding to the QAHC, which in turn uses that funding to make debt investments. The QAHC then receives interest returns from these investments, and it might also receive gains to the extent it holds equity or if pull-to-par gains on debt are expected. So if we look at the funding structure, in a credit fund context, the funding of the QAHC will be determined by the investment strategy, the accounting approach, and the position of investors. So if, for example, the investment strategy is mainly lending, with the expected return comprising interest and fees, then the funding structure could be relatively straightforward. The QAHC would simply be funded through a relatively small amount of ordinary shares and the rest through a profit participating loan. The PPL would then strip out the underlying interest income received by the QAHC, less a transfer priced margin. And as Simon mentioned, the QAHC would get a deduction for payments made under the PPL and there would be no withholding. So that's relatively straightforward. If the investment strategy includes acquiring secondary debt at a discount such that material capital gains are anticipating, then funding the QAHC solely through a PPL would be disadvantageous because returns to investors, including carry holders, would be in the form of income rather than capital. So where gains are anticipated, the PPL could be supplemented with a combination of convertible loans and tracking shares, thereby sheltering pull-to-par profits from corporation tax, whilst also potentially extracting them to the fund and investors as capital gain. Now, it will be necessary to get the accounting right, and care will also need to be taken to ensure that the deeply discounted security rules don't apply to override the capital treatment and the tax for the return as income. Now, that's broadly the sort of structure that we've been thinking about. Some clients have asked why they should consider using a QAHC if their current Lux structures are working well. And generally, if we compare a Lux holdco with a QAHC in a credit fund context, the tax treatment is actually fairly even, but I think the key differential and advantage of using a UK QAHC comes down really to substance. So you probably all know now that the EU has published the draft 883 directive designed to tackle the misuse of entities that effectively don't have sufficient substance. And whilst that directive will probably be less of an issue for those managers that have established Luxembourg platforms and have an office and people on the ground in Luxembourg, the directive may pose a problem for those managers who mainly use service providers to carry out those functions from Luxembourg. And I'd say that even for those managers that do have sufficient substance in Luxembourg, we are seeing some jurisdictions challenging treaty claims to minimise withholding. And that's on the basis that even though those clients might have people on the ground in Luxembourg, the key decision makers are actually in London. So in light of that, you know, some clients might find it easier, and it's a future-proofing point, that a QAHC might be better than a Lux structure. So that was all I was going to say on credit funds. I'll now pass over to John, who's going to look at real estate funds.
Thanks, Elena. As we've heard, one of the asset classes that benefits from special UK tax treatment under the QAHC regime is non-UK real estate. So one of the things we've been thinking about is using QAHCs for holding real estate investments, specifically using them as a holding platform for pan-European closed-ended real estate funds. There are a number of different holding structures used currently, but one of the most common is perhaps to use a Luxembourg platform. So we thought it might be interesting to have a brief look at a typical Luxembourg structure to see whether the UK tax benefits of the QAHC regime make it viable to replace the Luxcos with QAHCs. Hopefully the answer is yes, otherwise I would say the new regime is probably not fit for purpose, but let's find out. A couple of caveats before I carry on. I'll inevitably need to touch on non-UK tax matters relating to the underlying investment jurisdictions, And where I do that, it's based on my understanding of the position. I'll also assume that the various eligibility criteria are met, including that the propcos are investing, not trading, which may not always be straightforward. And I'll also only be considering the holding platform itself, rather than anything at fund level or above, which we've already heard a lot about. So to set the scene, here's a vanilla Luxembourg holding structure on the screen with a master Lux holdco at the top, owning shares in one intermediate Luxco per jurisdiction, and those in turn holding shares in local propcos. We've got 4 jurisdictions in this example, UK, Germany, Spain and Italy. And all the propcos other than Germany are resident in the same jurisdiction as the underlying real estate, which is standard for countries which tax non-resident companies and resident companies in broadly the same way on real estate returns. German real estate is typically held offshore, so the propco there is in Luxembourg, and it's typical in Spain to use a double Spainco structure, partly for tax reasons, so I've shown that on the picture too. Obviously, there are other vehicles that might be used, but this is, I think, a simple but realistic starting point. As regards funding structure, again, there are many different ways this can be done, but at the top, master holdco generally funded by a mixture of debt in the form of interest-bearing loans or profit participating loans or both, and then equity subscribed as tracker shares tracking each underlying investment. The purpose of the tracker shares is to enable exit proceeds to be returned to investors as share buybacks free of Lux dividend withholding tax. Master holdco will then fund the intermediate companies using the same debt to equity ratio and debt instruments, but irrespective of whether PPLs are used for that purpose, the intermediate cos will then fund the propcos with interest-bearing loans, because those entities will want a tax deduction for the interest against their rental income, and most countries, of course, don't give a tax deduction for results-dependent interest, so PPLs won't work at that level. What you end up with, I think, is a pretty tax-efficient structure from a Luxembourg perspective. Rental income can be flowed up the structure as interest, or perhaps loan repayment without withholding tax, and with a minimal transfer price taxable profit at each level, subject to interest barrier and anti-hybrid rules, etc. And then disposal proceeds from direct or indirect disposals of the underlying real estate can be repatriated via PPLs or dividends up to master holdco, and then via buybacks of the tracker shares, as I've already said. So there'll obviously be tax costs in the underlying jurisdictions, which will generally look to tax the rental profits and gains, direct disposals from direct disposals, and in some cases indirect disposals too, but that's inevitable wherever you have the holding company platform. So the million-dollar question: what would happen if you replace the red Luxembourg entities on this picture with QAHCs, shown here as green entities? Is it possible in this scenario to basically replicate the tax outcome, at least insofar as UK tax goes? Well, in broad terms, the answer should be yes, you can in most respects, but let's look at some of the specifics and why the QAHC regime is necessary to achieve that. Firstly, looking at the German propco QAHC at the bottom there, it will be exempt from UK corporation tax on its rental profits and gains from disposing of German real estate. So there's no need to make a claim for credit or relief from double tax under the UK-Germany double tax treaty. Germany will just tax those returns in the normal way. The Italy and Spain propcos are unaffected, of course, because they remain tax resident in their respective jurisdictions. Secondly, looking at the intermediate QAHCs, they will be party to the PPLs under which they are the borrower for the purposes of their ring-fenced activity, which is holding qualifying shares. So the interest on those debts will not be recharacterised as distributions and will be deductible in principle. You might not always use PPLs, of course, but if you do, that's a big benefit of the QAHC regime. There will need to be a transfer price taxable profit retained in the QAHCs, but the indications are, as we've already heard, it should be possible to keep that to a low level, particularly where PPLs are used. Similarly, the intermediate QAHCs will be automatically exempt from corporation tax on gains on disposals of shares and propcos, rather than needing to rely on the SSE, which in this context where you have non-trading entities is particularly difficult because it relies on the underlying investor base and may not be available at all. So again, the QAHC regime is actually essential to make this structure work in the UK. And then moving up to Master Holdco, it too should be able to keep its income profits to a manageable level for the same reasons, and also will be able to receive capital proceeds free of UK tax and then return those exit proceeds to UK investors in capital form on buybacks of tracker shares. Although, of course, there's no dividend withholding tax issue in the UK as compared with Luxembourg, so you wouldn't need to do that if there weren't other reasons to do that. And finally, there won't be any UK withholding tax in the structure at all on debt or dividends. Of course, if Master Holdco was not a QAHC, as we've already heard, you'd need to think about a workaround for the withholding tax on the interest at the top. The eagle-eyed amongst you will have noticed that the UK PropCo is not a QAHC, and the reason for that, of course, is that its activity is letting real estate, UK real estate, is taxed in the normal way. It wouldn't be within the QAHC ring fence. Same goes for the intermediate co, since it wouldn't have any QAHC ring fence business either, since the shares in PropCo are not qualifying shares. So Master Holdco's participation in that intermediate co would not be funded by PPLs because the interest would just be recharacterised as a distribution the normal way and therefore would not be deductible. So that's a bit of a disadvantage as against Luxembourg, where you could use PPLs at that level, but it should still be possible to make IPLs work.
It's not all plain sailing because the QAHC rules aren't a panacea. They don't solve all UK tax issues, so there would still be UK stamp duty on sales of shares in UK incorporated QAHCs, although happily in our example of the German PropCo, that shouldn't be too much of a concern because German real estate sales are generally structured as asset deals. You've also got the UK hybrid rules that would still apply, of course, but that's broadly similar in Luxembourg and should be manageable. And then we've also heard about the need for distributables to affect share buybacks. That's something else that would need to be factored in. But overall, from a pure UK standpoint, we think you can get to a good outcome that's broadly comparable to Luxembourg. That's not quite the end of the story, though, because, as I mentioned at the beginning, it's also necessary to consider the local law perspective in the underlying real estate jurisdictions, particularly in relation to withholding tax on interest and dividends paid by a PropCo to a UK QAHC. In one sense, QAHCs are at a disadvantage to Lux Holdcos in this area because since the end of the Brexit transition period, they won't have access to the interest and royalties and parent subsidiary directives to knock out withholding tax. But on the other hand, as we've heard, QAHCs won't, at least for the time being, be subject at all to the ATED 3 substance rules. And so where there's a treaty in place for the QAHC to rely on, it arguably puts them in a better place. So to finish, we'll just take a quick look at the withholding tax position in each of our 3 non-UK jurisdictions. So firstly, you have Germany, where there shouldn't be any German interest or dividend withholding tax at all because, broadly speaking, those entities are not German tax resident. There's a few other nuances there, but in broad terms, that's where you should get to. So there's no need to rely on a treaty or a directive, simply no withholding tax either way, so that's all good. In other cases, you have withholding tax in principle, but it will be possible to reduce the rate to 0 under a tax treaty, and a good example of that is Spain. To rely on the treaty, the QAHC would need to be able to show that it beneficially owns the interest, and that's where there's potentially a bit of tension with the use of PPLs, which strip out all the profits of the QAHC, other than a transfer price margin, and therefore make it look a bit like a conduit, arguably not beneficially owning the interest. The tension being that using PPLs actually gets you to a better place on the transfer pricing, arguably, as Simon mentioned earlier. The Spanish tax authorities will also expect the QAHC to be able to demonstrate that it has proper substance in the UK, and there the QAHC should be in a decent position if the key senior people advising the fund are in the UK, so that would be a point in their favour. And then finally, in Italy, there will be similar beneficial ownership substance points to work through, but there the UK-Italy treaty would only reduce the rates to 10% for interest and 5% for dividends. So that's clearly not as good as for Luxembourg because, on my understanding, there is unlikely to be a local workaround there. So Luxembourg entities would get to rely on the directives in that scenario, although ATED 3 might make that less straightforward. So just to finish from me, clearly the government's hoping that the QAHC regime will entice new funds to set up their holding platforms in the UK. But their recent consultation on introducing a new redomiciliation regime suggests to me that actually they are also looking to get existing funds to migrate their platforms across. So that sounds like a real statement of intent to me, and is an interesting area. And then finally, there are lots of tax and non-tax points of detail to work through, but I think there's real optimism that the UK regime, the QAHC regime, does make the UK a viable alternative to Luxembourg and other traditional holding company jurisdictions for these sorts of funds. So it'd be really interesting to see how this develops.
Thank you, John. Always nice to end on a high note. Thank you all, everyone, for joining. I hope you found the session useful. If you do have any questions, please do feel free to get in contact with us. So thanks very much and have a good afternoon.